Hey everyone, another wet and windy day, I'm afraid, in Joburg. Not the case in Cape Town. I see people sort of swimming and what have you, but I'm rather envious. Anyway, this isn't about me and the weather, even though I'm British and we love talking about the weather. I am today joined by someone that I've been wanting to get on the podcast pretty much since we started, and his diary is all over the place, as is he. I'm talking physically, not in any other way. But Mr. Johan Bosini has joined us. And for those who don't know him, this is investor extraordinaire. If you don't know him, the only chance of you not knowing him is if you don't actually work in fintech, because anyone that works in fintech will know Johan without a shadow of a doubt. Wherever I go and I go, looking for an investor. Have you ever spoken to Johan? They're like, yeah, we're best friends. So either everyone claims to be best friends with you, or you literally have kind of the biggest phone book I think I've ever seen. But it's amazing to have you here. Thanks so much. I've bigged you up massively. Not that I'm after your investment, although that would be nice. But for those of our audience, perhaps are tuning in from overseas or are just interested in the sector, may not have come across you and Quona Capital. Quick overview, quick intro. That'd be great.
Thanks, Darren. Yeah, wow, what an intro. I should get you to speak to my wife more often, maybe, and tell that story. It makes me sound really, really good. Thanks for having me on. Quick intro. Yeah, we're a global emerging market fintech for inclusion venture firm. What does that mean? Breaking it down, we only invest in fintech, so that's all we do. We only invest in emerging markets, so that would be Latin America, Africa, MENA, Asia. So although I say only, it is a very broad geographic focus. And stage-wise, we focus on late seed, Series A is typically the stage we like to invest at. Having said all of this, the one real focus, though, is financial inclusion. So we're not an impact fund, but we're a venture fund with an impact lens. And I guess that's really an important distinction in that we are a commercially focused fund, but we only invest in this particular theme where we believe technology can fundamentally change the way people in emerging markets can access financial services. So it's really focused on the underserved or the underbanked. We're as I mentioned, global team. So the team is spread between Latin America, Africa, MENA, the US, and Asia. There are 27 of us. We're on Fund 3. We've invested in, I believe it's 77, I think it is, companies now across the globe. Very much, again, in this fintech vertical. So lending businesses, challenger banks, insurance, wealth management platforms, payments, etc. I'm based in Cape Town. And yes, the weather is great today, so it doesn't sound as bad as Johannesburg, sorry. But the rest of the team, like I said, is really on the ground in the markets where we invest. We're on, as I said, Fund 3 right now, and very much business as usual. Although the market's obviously challenging, we're still investing.
So out of the 77 odd investments that you've made, monetary-wise, how much has Quona Capital kind of invested?
Sure. So we are sitting on about $750 million in AUM right now. We typically invest between $2 and $7 million as an initial investment, although we have been making some earlier stage seed investments more recently in the last couple of years. But typically it's around that 2 to 7 million mark. And then we reserve capital for follow-ons. So we'll continue to invest in a Series B and maybe even a Series C. But it's approximately $750 million in AUM.
So what are some of the fintechs that perhaps our audience here in South Africa would be familiar with? A couple you can name off the top of your head?
Yep, absolutely. So in the beginning, we invested in Yoco. I'm sure you'll be familiar with Yoco, as many people will be. Really strong thesis around financial inclusion, where although you can use the Yoco device in some more established organizations, buying a skim milk cappuccino in a fancy coffee shop, the majority of the devices are still being used in smaller businesses, where I think the last number I saw was about 75% of businesses had not accepted cards before Yoco came along. So, it's a very long tail of smaller businesses. Another one would be Lula, and it was called Lula Lend, have now pivoted or added additional products. They're now a full-blown SME bank. But really the key focus there is access to working capital. So we like this theme of enabling small businesses where Yoco on the one side is card acceptance to begin with, and then Lula Lend is obviously focusing more on working capital for small businesses that are not small necessarily, but they are struggling to access typical working capital from traditional banks. They're just too small to really fit into that mold. Then we've invested in another business focused on SMEs, Sava. It really is around expense management for small businesses. So you can maybe call it the Brex of Africa is what they're positioning themselves as. And then a bunch of others as well, some earlier stage and some later stage. But a lot of our investments have also been in the other big markets in Africa, so Nigeria, Kenya, and Egypt as well.
So let's talk about financial inclusion, because you mentioned that at the beginning, and you spoke about Yoko, you spoke about Lula. I think when people talk about financial inclusion, they talk more about the consumer side, right? So it's more about Joe Bloggs on the street. How do we include that person? How do we get them either access to our bank account, access to credit, etc.? Some of the investments you've made, though, let's look at Yoko, let's look at Lula, is very much focused on enterprise, right? Whether it be micro enterprise, SME, whatever it may be. So there's a financial inclusion play there. Can you just describe from investors' perspective, when you're looking at financial inclusion, how would you then go, Yoko is on a mission to financial inclusion, as is Lula?
Yep. No, it's a great question. So we have invested in quite a few consumer-focused businesses in other markets. I think if you look at the evolution of fintech over time, let's call it fintech 1.0, was very much pure play product providers. So lots of lending businesses. In Africa, we saw lots of lending apps. We saw the same in other markets as well. And then this, over time, I think we saw a more complicated rebundling happening. So maybe call it fintech 2.0, where businesses realized as a pure play product provider, it sometimes can be difficult to make the unit economics work. High acquisition costs, single revenue stream of one product, and there's a need to add additional products over time. Where we are now, I think, is also this interesting stage of we've seen quite a few, I guess, fintech enablers in some ways and financial infrastructure players, where guys are coming in and building really interesting technology layers that are enabling an entire category. So let's take insurance. You've got players like Root and others who are coming in saying, let's build this operating system. You've got lots of open banking players. You've got, well, not lots, but there definitely are a few emerging, payment orchestration, etc. So rather than just being pure play, is really an enabling environment. When it comes to financial inclusion, we've looked at a bunch of consumer products where there's still a question around, is this transformational for a consumer? So if it's another lending business, for example, or lending product, if it's locking someone into a debt cycle and then it's not really transforming them into being, long-term debt-free, for example, then there is just a question around, is this the right use of capital for us? Where SMEs, it just has been a bit easier because it's productive capital, especially in emerging markets where majority of the jobs and the new jobs being created are coming from the small businesses rather than enterprise. So you're really supporting these small businesses with access to capital to grow, which means hiring more people, which means really getting to a position of thriving, rather than just consumption, where a lot of the consumer businesses have historically focused on consumption. We have invested in a few, so there are, I think, some very interesting models. In South Africa, we'll obviously know of all the buy now, pay later players. That's an interesting category. Early wage access is another one. So there is a need for them, but again, in certain sectors, we found it's either hyper competitive, so maybe we haven't got involved. And South Africa is in many ways a very competitive landscape. You have some very successful and progressive traditional financial services players who are actually doing a really good job. Obviously, we have outliers here like Capitec and a few other players where the opportunity might not be as obvious, where on the consumer side, markets in Latin America and Asia, I think there are fewer incumbents that have done a great job. So the financial inclusion thesis there or delivery, I think, can be a little bit more superior to what we're seeing in some markets in SA or in Africa.
That's super interesting. Before I press record, you said to me, "Oh, I can't believe it's November." And I think my initial reaction was, "Yeah, it's been a year, right?" Quite pleased in some respects to see the back of it. What's the year been from your side and from your lens? And again, I appreciate other markets that you play in, and there's lots of sort of macroeconomics that come into play and different geographies. If we look domestically first, and then perhaps we sort of expand outwards, maybe we'll go a bit further north, and then we'll go east and west. But what's been happening here in the VC sort of landscape over the last 12 months?
Yeah, it's obviously been a really interesting time where it's a reset, maybe is the right word, where I think in 2021 and part of 2022 there was it was far too frothy. There was just way too much going on, way too much capital, rounds were happening really quickly, a lot of foreign capital coming into South Africa and Africa. Yeah. And I'm not sure whether they always made the best decisions as a result, right? I mean, these are very good investors at times, but not necessarily with a deep understanding of the local landscape, right from the growth opportunities all the way through to exits and returning capital to their investors. So you definitely had some rounds that probably didn't make sense. And now what's happening is there's this, I guess, a recalibration of sorts between all the investors across the globe to really rethink where should capital be deployed, what kind of businesses should we invest in, what kind of valuations make sense at the point of entry, taking into account downstream capital, taking into account the market size, taking into account what exits could look like. So I don't think where we are is actually a really bad place on balance. I think it's very difficult for certain businesses and certain funds who might have been caught at a time where they either deployed money too quickly or they raised money at too high a valuation and they haven't grown into that valuation. However, this is not the first time, and this won't be the last time there's a market correction. So I think it's a natural cycle that we're in right now. What that means is that I think a lot of businesses have to really take stock of where they are and make some hard decisions around their funding roadmap. You know, where are they today and how much longer can they survive without raising money? And it really is around cost rationalization, really looking at revenue opportunities rather than building for growth only, because that growth capital might not be there unless there's something of substance. So I think we aren't at the bottom of the market, personally. I think we are almost there. We are seeing signs of recovery in some instances. And really what's happening is the world continues. There are some businesses that probably will fail, which is difficult in many ways. Having said that, we are seeing lots of funding events happening, but in particular categories and at valuations that are different to what they were 2 years ago, and with a expectation of a future roadmap being just a little bit more sober, perhaps, than people had initially come into the market at. So definitely a slowdown, recalibration. The world continues, and actually I think there's some great opportunities. We're seeing some brilliant founders in really interesting verticals being really progressive in what they're building and getting the right funding for the business at that point in time, rather than just taking the first money that comes their way. Yeah. For the rest of Africa, I think it's very much the same. We're seeing a big slowdown. We have, unfortunately, challenges, and being a founder is hard. It really is. And I feel sorry for many founders that we talk to, where sometimes it's entirely out of their control. The macro in some markets in Africa right now, Egypt, Nigeria come to mind, currency. These are difficult things for a founder to control. They can't, right? So we are seeing big question marks around what those ecosystems are going to look like in the next 6 to 9 months. And in the rest of the world, Latin America, Asia, I think they're far deeper markets than Africa is at the moment. My guess, Africa's maybe 7 years, 5 years, you can choose, behind an ecosystem like Latin America, and just we don't have that depth of capital in terms of downstream capital, in terms of local fund managers, local LPs. So we're still getting there, but I think we've really come a long way in the last 5 years, which is encouraging at least.
And then from an you mentioned there was obviously international investors coming into the market, and has been for a number of years. Has there been or has grey listing had a negative impact on that? I'm going to ask you two questions. Has grey listing had a negative impact on that? Or on the flip side, given the sort of devaluation of the rand, has that actually prompted more people, more investors to go, actually, would have cost me X, a year ago is now costing me Y, and it kind of makes sense to go and do this deal. So are you seeing both of those conflict with each other, or are they two completely separate matters? Or what's the view from sort of external funds coming in?
So I think the grey listing definitely has an impact, or has had an impact, a negative one, and I don't think that's countered by the exchange rate. I don't think people are saying, well, I'm coming in at a much better price. Generally, deals are priced in dollars anyway, so it's better for the company maybe that has a better exchange rate, more working capital within the business. Yeah. But it definitely has impacted things. Well, what I'm seeing, and this is not everyone, but we are seeing a lot of the international investors just taking a step back and pausing. Again, no news of we're leaving, but just let's pause and recalibrate, like I said. Then I'm seeing quite a few local Africa-focused funds re-looking at South Africa it's quite an interesting dynamic where I think a lot of people have deployed lots of capital into Nigeria and Kenya and Egypt for good reason. They're big markets, they're quite robust, they have great founders. But South Africa has not had as much interest over the last, I'd say, 4 or 5 years. And I'm beginning to see quite a few of the Africa-focused funds re-looking at South Africa in many ways. And one is just portfolio construction. Let's have a more even balance between the big core markets in Africa rather than having concentration risk in one or two markets only.
Scott, could you design a video game?
I could make you a hypothetical one. If I took some random genres, mechanics, maybe blended them together, and created a new hypothetical game.
Now that would make a great podcast.
Undoubtedly.
So what would you make? Something original and exciting? A Dark Souls city builder? A co-op roguelike?
Everything. All of that. We could use the Nemesis system from and put it in a first-person shooter. And we could have a loot system with survival mechanics and motion controls. And maybe you could... I don't know, save a kingdom from some out-of-control toasters. What about party?
Catch the Gaming Blender on all your favourite podcast platforms.
Okay. And are those funds from any particular countries? Is it more sort of Nigerian, Kenyan funds that are looking into South Africa, or is it sort of far-fetched than that and it's or Sudan or wherever else? I don't know where there's any money there, but and Francophone as well, because that's a very interesting market. But are they looking at diversifying their sort of portfolios and looking at South Africa as a potential market for them?
Yeah, no, good question. I guess the guys that I've been speaking to are more Pan-Africa focused funds, but within the big four markets as a primary focus. So again, I forget the actual numbers now, but I think the numbers I've seen thrown around would be 98-99% of capital in Africa goes into the big four markets. And the reason really just comes down to market size. The best founder cannot create the market. It's either there or it isn't there. So if you're looking for venture style returns, you need to go into a market that's big enough. If I look at the investors that have been investing across all four, I've just seen some that have done very little in South Africa historically, and they're now looking to deploy more money in South Africa. Having said that, I guess time will tell. When the market changes and there's more capital in all markets, will people choose not to focus on SA? It's a bit of an anomaly in some ways, I think. We've got so many alternatives to capital and businesses raising money here, where the corporates are very, very active. And there are a few examples of businesses that have raised money not from VCs in the early days. The others where they're just high net worth individuals or angel syndicates, where there's so many ways to build a great business. VC is one of them. It's not always the best way to build a business, right? Depending on what the founders are trying to build and what the product is that they're offering. So no, I don't think it's disparate capital coming from smaller markets now looking to diversify. I think it's Pan-Africa venture firms that we know well who are looking to just have a bit more of a balance between the core four markets.
What about Middle East and sort of Asia? Money coming in from China, or whether it comes in from Japan, or whether it comes in from the UAE or from Saudi or Qatar. Are you seeing any trends in that direction, or is that, again, is it not really sort of on the radar?
No, we definitely are. There's a lot of Asian capital coming in. It's still, I think, again, I don't know the ecosystem perfectly, but some of the smaller investments are coming from international capital from Asia, for example, or from the Middle East. What we are seeing, and I think there was an announcement today of one of the funds raising capital from Asian sources, where it's more around LPs investing in local GPs. So finding a local partner who has a team on the ground, good connections, good network, they know the ecosystem, they know the founders, they know the markets, etc., rather than international capital coming in, investing out of a country that is just obviously very different to what we have on the ground here. So it's more backing of local GPs or local funds with a local team, but that's a very encouraging sign, because again, as we see more international investment coming into local funds, it obviously just builds up the ecosystem and allows for a more robust ecosystem relying on local capital or local deployment rather than always looking internationally for downstream capital.
I think what's interesting, again, from an outside sort of looking in on the venture market, is Well, the volume of deals this year has definitely significantly reduced, but some of the ticket
Yeah.
sizes have been, very, very meaty. I think it was 2 or 3 weeks ago. There was over $60 million raised in the space of, well, I know it wasn't raised in 3 days, but it was announced in 3 days.
Yeah.
And some really significant rounds there. So is that a fair sort of assumption
Sure.
of what the market has done this year, or
Yeah.
lower volume, higher ticket?
Yeah, it's I think you have a few outliers. Majority of the deals, I think, has been a scenario of fewer deals, lower ticket prices, or lower investment amounts. A lot of the later stage investors or investors who like to write larger investment sizes have just simply continued investing, but being a bit more cautious, focusing on price, focusing on really making sure they understand the theme and writing smaller tickets.
Yeah.
The bigger investments, I think, is a function of, which is very encouraging, of a lot of activity happening in the last 4 or 5 years in the earlier stages of investment. So a lot of seed rounds, lots of Series A rounds. And really it's this maturity of certain businesses who've succeeded, who are then raising bigger rounds as they continue to scale, which is a very different conversation with the investor. It's about, it's not now proving the business model. It's really around taking a successful business model and scaling it. So for me, I'm really encouraged by the amount of investment in the earlier stages, which is now coming through into a space of justifying larger tickets. And we're going to see a lot more of that, I think. So as more businesses in the next couple of years are able to continue scaling, even through tough times, I think that's where the ecosystem almost completes itself, right? Where majority of the investments have been Series A, and we've seen a few Series Bs. I think I counted last year, I could be wrong, there were 8 Series C deals in Africa last year. So it's really early days, and that's beginning to grow now, which is very encouraging.
We had a conversation a couple of weeks ago when we were meant to be talking about something else, and we spent an hour talking about the market. And I said, you know what, we should have pressed record, and that would have been our podcast done. And we were talking about this kind of unicorn status, right? And I think we had quite a healthy conversation around, is there going to be, or is there potential of there being a unicorn from South Africa? Now, obviously, we've got a couple of other parts of the continent, but in South Africa, you've got quite a different view on that to what I thought you'd have. Are you at liberty to share that, or are you going to piss off?
Sure. And I'll try not to be Switzerland here and say nothing. The short answer is yes, absolutely there will be. The question is when. And I think it also then goes into what kind of business are you building. So I think every founder should really, and every venture firm as well, should have a view of what an exit looks like. Now, again, not to talk about kind of venture 101, but if a founder is not looking to drive a business to scale and then exit, then they shouldn't be raising venture capital to begin with, right? It takes them on a particular journey. And that's where, if you're aligned, that partnership can be really powerful.
Sure.
If I look at a lot of the businesses that have launched and have a view that they will sell to a bank, let's say, then I just think we have to be quite realistic around the liquidity in any market, whether it's South Africa or somewhere else, of would a bank have that kind of appetite and liquidity to be able to buy a business for $1 billion? And I think typically the answer is it's a very low probability, right? Just in terms of access to liquidity in a tough market, would a business be willing to take that risk? In a market that is not enormous. I mean, it's big enough to build something meaningful, but it's not as big as a market as obviously India or Indonesia or Brazil, etc. We have to be realistic around what size the market really is. So I think in certain categories where it really is a technology business that could be applicable or interesting to a global or international buyer, then the answer is absolutely yes. But if you're building something which is likely to be bought by an existing local financial services firm, then again, I think we have to be intellectually honest with ourselves around what kind of appetite would a firm like this have, and what capability would they have. And when you're talking about multiple billions of dollars, which is obviously a lot more in rands, then I think we just have to look at history and say, what examples are there of really large exits to local buyers versus international buyers? So if you have a business that could be bought by Alibaba, let's look at that. Would Alibaba want to buy something in South Africa in the next 5 years? What would they want to buy? So those are the kinds of conversations and considerations I think we have to take around which verticals in this country would justify a price tag like that, which is significant.
You mentioned earlier on that valuations obviously are not the same as they were, a couple of years ago.
Yeah.
We have a mutual friend who clearly got out at the right time, but we won't go into that now. And are you seeing that? Are you seeing that founders now are a little bit more humble when it comes to valuations? They're not looking at these crazy numbers that were being floated around a couple of years ago. And, you could go to, I'm paraphrasing slightly, but you could go to a VC with a PowerPoint and go, hey, look, we're going to go and get 1 million customers. And they go, hey, take the money. There's a lot more maturity now that's happened. But from a founder's perspective, the conversations you're having, maybe at early stage when you're sort of scouting each other out, are you finding there is a bit more realism in the market? Or are people still gunning for these crazy multiples?
Yeah, it's a great question. On balance, I think everyone is realistic. I think reason prevails in any conversation eventually. And on balance, absolutely. We've seen a number of good founders and good founding teams who are hyper aware of the state of the ecosystem. And I think they've been very progressive in preempting sometimes these conversations around valuations, especially when they're around extensions. So on balance, I think it's been good. Are there outliers? Absolutely. We've seen a number of businesses with a certain expectation, which is unreasonable. And I think there again, I don't necessarily blame some founders. It's their job to try and dilute as little as possible to get the right partners on board, to get the right liquidity on their cap table and be able to scale. So an ask is one thing. And what we typically have done is just have very rational conversations around what has been happening around us, and not just in SA in this case, but globally as well. Where when you're looking at market comparisons, you can look at what multiples have been achieved, revenue multiples, or whatever valuation methodology, and say, let's compare it to what's happened in the last 12 months in similar businesses at a similar time in emerging markets in your category. Yep. And it becomes a very rational conversation to say, this is where the market is. Having said that, again, valuations are a hard thing to get right, because really what you're doing is saying, what will the business be worth in the future? And again, some people have an expectation which is not realistic. But again, I've seen most founders are actually really thoughtful, and there's been a reset in that sense.
Well, that's encouraging, isn't it? I think, if there's a mentality still that, we're going to go and, shoot the sky out and shoot the lights out with, I don't know, whatever the numbers were that people were shooting out a couple of years ago, and not really understand the sort of market dynamics, you would tend to wonder. Let me ask you a question going back to financial inclusion.
Sure.
This is a bit of a loaded question, obviously. Do you feel there is a play or there is an opportunity for cryptocurrency to help solve financial inclusion and inclusivity in emerging markets?
Whether you're a seasoned podcaster or just thinking of starting a podcast, you need to listen to Buzzcast from the folks at Buzzsprout. Here we go! Buzzcast covers everything a podcaster should know, from marketing strategies and how to make money from your podcast to the latest and greatest tech and industry insights to keep you on the cutting edge. Follow Buzzcast by clicking the link in the description or go to buzzcast.buzzsprout.com and keep podcasting.
Yes, is the short answer, and I'll qualify that. I think it's still early days in terms of figuring out where is the right applicability for any crypto, DeFi, Web3 type of business model or technology, should I say. And many of them have been historically, if you look at kind of the early days of crypto, whether it would be an exchange, and we've spoken to many of them, great founders, they built good businesses. But the first iteration was very much still speculation. It's people buying a crypto asset and hoping the price goes up. There wasn't that real world use case yet that made sense. We're beginning to see some really interesting models around driving liquidity into alternative lenders, and there are a few of those players right now in Africa and globally, where you're essentially tapping into a global liquidity pool and being able to then take that decentralized or DeFi approach to funding real world businesses who are trying to provide capital to consumers and small businesses. There's early evidence of that, but again, I do question whether is the business really about the DeFi component, or is it really about the underwriting of and giving a loan to fintech lenders across Africa in this case. And I think it's the latter to a large extent, where how we get the liquidity is one thing, but that's just a ticket to play the game. The real work is to sit with in this case, alternative lender and really understand, is this a business to back and to give access to credit or provide a loan to? So there's that. The obvious one where I think there really is an opportunity, but regulation is still a challenge because, again, Africa is highly fragmented with so many countries and so many regulatory environments that the remittance space is a natural opportunity to be disrupted around using crypto on-ramps and off-ramps and making just it really easy to transact. And the example we see is not just consumer, but small businesses. For a small business to pay for, let's make up a scenario, for stock that they're buying from Europe or China or anywhere for that matter, to go through a bank to do a $2,000 transaction or $500 transaction, it takes a long time, it's expensive, it's not transparent. And that's where I think there is an opportunity, but there's still the uncertainty of, can regulation kill the business overnight? And I guess as any investor, you can't invest in something unless you understand it. So there's still a lot of work, I think, being done on understanding this protocol of how it fits in, how do you protect customers, and how can you use the full power of it, but within an environment where customers' money is protected and investors can also have at least some kind of understanding of the roadmap of where it's going.
Yeah, and I think the regulatory side of that, especially when it comes to remittance, whether that be P2P or whether that be businesses, on the P2P side, it's very difficult when you have exchange controls in place. How does SARB or the SARS, how do they monitor those transactions, given the nature of crypto? And until there is such a thing as a CBDC, which is recognized internationally and is all on the same platform, it's going to be really, really difficult because, I could send you a Bitcoin, for example, and no one's none the wiser. It's down to me to declare that. Now, obviously, as a law-abiding citizen, I would. But that's not to say everyone would or everyone would know how to do that. So, I had to get that disclaimer in just in case SARS.
No, absolutely.
There is that element. There is a business that I know you've invested in as well, Virtu.fx. Which I think is a fascinating business. It really, really is. And the model behind that, correct me if I'm wrong, is that Virtu.fx basically hold multiple currency accounts for you as a business, and your customer can pay dollars into your dollar account and euros into your euro account. Yes, there is some sort of settlements that an accountant would need to look at in order for reporting, what have you. But you can then pay out of those accounts. So what you're doing is effectively cutting out the middleman and getting hit with a ridiculous amount of fees, but the red tape. I mean, just to pay. I paid something the other day, and the amount of boxes you have to tick, and the declarations, you're spending a way to send $50 to someone, which is crazy. But the Virtu.fx model, I think that they originated as kind of a forex broker, right, and then sort of grew up into this different model, is something that I would definitely pass as financially including SME businesses, because that is, excuse the French, but a pain in the arse here.
Yeah, it really is. I mean, again, this is a theme of SMEs and supporting SMEs with technology that just helps them be a better version of themselves. And payments is one area which we've seen in Africa has attracted lots of capital, both on the consumer payment side as well as the SME payment side. And I think historically it's been mostly on the consumer side. And we've seen that with evidence of either mega rounds or the exits that you referred to earlier, where a lot of those deals have been in payments. So I'm excited about the SME payment space particularly. The interesting thing there is, again, you can't get around certain requirements. And one of them is there needs to be a really good KYB process where I think the players who are building something meaningful and can really scale would be making sure that you do tick all the boxes when it comes to regulatory oversight, engaging with regulators, finding the right structures where it does stand up against regulation rather than fighting against it and trying to skirt around the edges. I do think there's a need, unfortunately, to also play the game and make sure that you do tick those boxes, because again, no one wants to have an overnight closure because you haven't taken into account the regulation in any market. The challenge there, like we said earlier, Darren, I think is when you're operating a Pan-Africa business, you need to take into account different languages, different currencies, which means your system has to be built for that, different regulatory environments, different cultural realities, different competitive pressures, where South Africa is very different, as we know, to, let's say, Nigeria, when it comes to competition in certain instances. So Pan-Africa is difficult, which is why I think a lot of the really successful businesses around the globe have chosen one really deep market and built something very meaningful in that country. Then you can control it. You live in that country and you can see what's going on. Pan-Africa or just multi-country operations is definitely a more difficult business to run.
I mean, look, South Africa's not small, right? We've got 60 million people. That's quite sizable. Yeah. You've got fintech companies that are set up in Qatar or in the UAE and are servicing a fraction of a market. Appreciate different types of models, but 60 million people is quite a market to target. Before I let you go, one more question for you, and you touched on it. The reg tech side of fintech, we talk about KYC and KYB. I think in order for consumers at lower LSM to be able to get onto the formal financial services sector, there needs to be a bank account. At the moment, there needs to be a bank or a telco with a mobile wallet associated to that individual to get them even on the ladder of financial inclusion. When it comes to KYC companies, of which they seem to have popped up all over the place over the last couple of years, is that an area that you would deem as being sort of having a financial inclusion angle to, or is that a little bit stretching it?
Yeah, it's a good question. You're right. There are a few players in the space. I think each market has a different requirement as well in terms of what KYC looks like and what level of identity is either issued by government versus other forms of the ability to identify someone. I think identity is critical. Without identity, you can't provide a financial service. In many instances, if you're providing a loan to someone, you need to report to, or the lender needs to report to a regulator on who they're lending to, for example. So they have to verify that this is the person that they're talking to, and it's a necessity to manage risk as well. So I absolutely believe that the identity players are key financial inclusion enablers. It's not a financial product, though, and I guess it comes down to the definition of what is financial inclusion. And the term I've heard thrown around is a step beyond financial inclusion, is financial wellness, where, strictly speaking, financial inclusion is it will entail a financial product. So it's either an insurance product or a lending product or a payment product, etc., investment product, savings, where a lot of the enablers are simply going, what are the building blocks to be able to have financial services firms offering products? KYC is definitely one of them. So I do think that they are key enablers. For us, I guess we've also seen that there are many of them, and there's a question around who will really be the winner, and will it be fragmented where there are winners in each country? I'll even go further than that. The other key one is beyond identity, is very often financial inclusion is preceded by digital inclusion, where very often the way you reach people who are in emerging markets who cannot get to a bank or who don't have access to formal financial services is they need access to a phone or a computer or the internet. And that very often is a requirement before you can start using financial technology to reach these consumers. So it's both a combination of access to a platform like a phone is the obvious one. And the next one is then identity. How can they prove they are who they say they are?
It's interesting on the phone side, though. Sorry, I saw a question.
Sure.
It's just
go for it.
I read yesterday that the other day that there's a company in Kenya that have just released a smartphone at $50 for a smartphone. You've got a lot of the Chinese vendors that have that supplied massive amounts of handsets into Africa, again, very, very inexpensively. But then you've got the data side and the network coverage. How do you do that? The telecoms regulators going to allow Mr. Musk to broadcast his satellites in country? I read a very funny story about the guy here that was selling the Starlink. I don't know if you saw it, but there was a guy here that was basically buying the equipment from overseas, registering the SIM card or whatever it is overseas in a jurisdiction that was allowed, and then just shipping the equipment, selling the equipment, going, hey, listen, it's registered in Belgium or something, right? The regulator didn't like that. They closed him down quite quickly. But, I think if there is that access to connectivity, we can connect, communities that have, are still sort of off the grid, and provide them with affordable handsets and devices, and then focus on financial literacy or education, and then look at the products that will be able to make a change to their lives. I know we both know Wayne over at 4G Capital and what they're doing over there with the loans and the financing for farmers, and really helping them build their businesses is fantastic. It's similar to what Yoko have done here in South Africa, right? It's not just use a point of sale device. It's how do we help you grow your business? The more business you do, obviously, the more merchant fees we make or transaction fees we make, so everyone wins. But how do we help as an SME or as an entrepreneur, scale your business?
Yeah, no, exactly right. I mean, it's interesting that I suppose two comments to it. One is we are seeing a number of firms launching who are focused on financing smart devices or cell phones. Where if you look at telcos historically in South Africa, there have been a number of formal retail environments where you can go get a phone, as well as the large retail chains who began selling phones, and you can finance them as well. So access to finance a phone here is obviously much better historically than it's been in other markets. But the startups we're seeing are guys who are buying refurbished phones in other markets where the price is lower, and then selling it in, and there are two in Kenya right now that we're aware of doing really well. The demand is enormous. And the telcos really love it because obviously they want more handsets in people's hands, which can consume data. So they're switching away from SMS revenue, which we know has dissipated massively, moving more into data consumption, which is obviously good for the telco. So, and then on Wayne and 4G, it's a really interesting example, I think, of this term that we've been hearing for a number of years of touch tech, where very often you don't change behavior by simply saying download an app, because there's no brand affinity, there's maybe an aversion to trying something new in the technology space. So it's initial conversations which are face-to-face, showing someone how to download the app and saying, I will give you access to working capital as a small micro business, in this case in Kenya and beyond. But thereafter, you now have this trust and this relationship where you say, if you'd like to access more capital in the future, you can just do it on your app. So you've got this touch component in the beginning, which is behavior change. It's trust building. It's reputation. It's showing someone how it works, and then switching out to more of a digital-only engagement on a handset or on a device.
Fascinating times, hey? It really is. As I said,
it really is. Yeah, no, it's
2023 has not been my favourite year. I've got to be honest. There's been. I'm quite, even the COVID years, the business was good, and I quite like working from home. Now I kind of been back in the office, but it's been a tough year. I think a lot of players in the market have felt the squeeze. Yeah. There's been, I think, a lot of nervousness around the market and uncertainty. I do feel there is more positivity. I do feel that people are now starting to make plans for next year. I know there's lots of significant projects that are kicking off in Q1, and I think maybe we haven't hit rock bottom yet in terms of market and valuations. But I think, as you said, we're almost there or thereabouts, and there is only one way from that point onwards. So fingers crossed.
Yeah,
a good 2024.
Totally agree. I'm actually really excited in the sense that it has been a tough year. I don't want to take anything away from that. It's been tough on multiple levels for many people and different parts of the ecosystem. Where I'm excited, though, Darren, I think, is the fact that if you look at, again, any development or the development of any ecosystem, is we now have a lot of founders who, and not just founders, but members of teams who have a whole new set of skills, new network, new relationships, an understanding of how venture works and how to build businesses. And we've seen this in other ecosystems, you can argue even in Silicon Valley, I guess, where failure is not necessarily a bad thing. It's a learning experience. Mm-hmm. And you have these kind of mafia groups that emerge from successful startups who then go, what if I start something? And I think it was Jumia where, again, that's a whole separate conversation, but I think there were 10 startups that we counted in Nigeria that were built by ex-Jumia employees. Because, again, they have this new confidence. And I don't think anyone should underestimate the network you build in terms of going, if I have had to build a business, that's the product person I'll approach. That's the data science person I'll approach. So you can move faster with more confidence, and ability to raise capital improves. So I'm really excited that coming out of this really tough time, we still have very smart, resilient founders and members of founding teams who we see at the early stages launching businesses. And again, as we know, second-time founder or repeat entrepreneurs, much easier journey in terms of speed to build a business and ability to raise capital. So I as tough as it's been, I think 2024, 2025, I'm excited.
But there's a lot of learnings to take from downturns, and I think if you look at sort of the demographics of, or the age, just look at age of founders, sort of a younger generation now, that if we hadn't gone through this period, the last 5 or 7 years have actually been easy, right? And I say that, and I need disrespect.
Yeah.
But there haven't been any huge challenges other than COVID. Okay. But I think what we've seen with a tough market, and I think I've been through 3 global recessions now, is if it doesn't kill you, it kind of makes you a bit stronger, makes you more resilient, right? And you go, actually, I'm going to dust off the doomsday plan, and this is what we do in this kind of scenario. And I think there's been a bit more maturity around founders or founding teams or people that are relatively young in their careers and have gone, actually, this is what hard work actually is, right? We actually have to graft. Okay. I can't go to the gym 3 times a day. I can only go once. And I can only, I know, I'll go on and on about that. But anyway, so I think, when there's every negative, there's always a positive. That's my taking away from this.
Yeah, exactly. And look, I mean, I don't want to take away or kind of, it'll be remiss of me not to say that, here we are talking about founders, and you're a founder yourself, right? I mean, so hats off to all founders in terms of this incredible resilience, which is quite astounding when you really look at it. It's very easy to sit on the outside at times and say, oh, that business did really well, they were very lucky. But as we know, there are many failures for few successes, and I really admire the fact that people can get up after tough conversations, tough periods of time, and dust off and carry on going. So hats off to you guys.
Well, I was going to say, I would have enjoyed a meal a few weeks ago in Cape Town at a restaurant I'd really been wanting to go to. Someone and his wife stole my ticket. Anyway, we won't go to that. Johan. Thanks so much.
I definitely owe you dinner. No worries at all.
Absolutely. Listen, thanks so much. I really, really, really value your time, and I know you're a busy man.
No problem at all. Thank you. Really appreciate it.
Yeah. If anyone wants to reach out to you, I guess LinkedIn is kind of the place.
Absolutely, no problem at all. Happy to chat to anyone.
Awesome. We'll put some links down here. You go and enjoy the sun. I'm going to go and warm up a cup of hot chocolate or something and sit on the side.
Fantastic. And see you in Cape Town soon. Thanks, Darren.
See you soon. Take care.
Thanks. Ciao.